Welcome to the Mental Health Market Update, where we talk about what's happening in the mental health industry. Here's your host, Stephen Hayes.
Welcome back to the Stigma podcast and another mental health market update. I'm your host, Stephen Hayes. And before we get started, I just wanted to say thank you for being here. And remember, we are listener supported through our Patreon page where we post detailed write-ups of our market updates. We regularly share research reports we're reading on the healthcare space, and we post updated trading comps relevant to our space a few times a month, along with other trading levels and valuation data that we find relevant. If you're looking for valuation and market insights relevant to the behavioral health startup space, this is a good place to go, and it supports our mission of bringing our content to life. Okay, enough of the commercial. Let's get down to it. With second quarter 2020 earnings announcements just around the corner, I thought it would make sense to take stock of where our disruptive healthcare peers are trading, how they've performed so far this year, and what to expect and watch out for as they release their earnings in the coming weeks. In today's episode, we are focused on a subset of our disruptive healthcare peers, which as a group broadly includes Teladoc, Livongo, One Medical, Health Equity, Progyny, Health Catalyst, Phreesia, Ontrak, which was Catasys prior to this week, but they changed their name, as you're probably aware, HCA, Universal Health Services, and Acadia Healthcare. The last three names are really not in the disruptive group, but highly relevant to our space nonetheless for obvious reasons. On an enterprise to next 12-month sales multiple basis, this group is trading at an astonishing 11x NTM revenue right now. That's up from 5.4x at the low on March 16th of this year, and it's above the last 12-month average of 7.6x revenue. This group is getting a lot of buying action from investors right now. Just to give you a little bit of context, over the last 12 months, the average next 12-month revenue estimate among this peer group has increased 41%. While an equal weighted index of these companies' stock price has traded up 69.7% over that period. This is a group with a mean EBITDA margin of just below zero projected for fiscal year 2020. Is that a red flag? But I digress on valuation. As we head into earnings, I'm focused on three of these companies specifically: Livongo, One Medical, and Teladoc. Why these names? We've been talking about them a lot lately, and they align with the key aspects of business models relevant to up-and-coming disruptive mental health companies that we have invested in, we are investing in soon, and hope to see do well, regardless of whether we invest. Let's start with Livongo. Livongo's stock price is $103.56 as of market closing yesterday. This represents an increase of 313% since January 1st when the stock was at $25. That's incredible, right? The stock has approximately doubled since reporting Q1 earnings back in early May. Today's stock price puts the valuation at 29x fiscal year 20 revenue versus the broader peer group of about 13x on average. Just to give you some perspective, the 2020 revenue multiple was 6x back on January 1st. All that multiple expansion. That's incredible. Or is it something else? We're going to find out. There's no better example of a digital healthcare company benefiting in a post-COVID environment right now, in my opinion, than Livongo. Just last week on the 7th, the company pre-announced their second quarter revenue to be between $86 and $87 million, which is up just over 110% year over year and up more than 16% over prior guidance of $73 to $75 million. What's driving all of this? Well, according to management, they're seeing an accelerated ramp in membership. I'm very keen to see the details in the earnings call coming up on August 6th. The details of this earnings call will be linked in the show notes so you can find it. This includes the date, the dial-in, the link, and everything you need to be able to listen. So what else are we going to be watching for as they report their earnings? Really three things. Number one, we want to see exactly where revenue shakes out, but more importantly, we want to know what the company has to say about the revenue. What is the commentary about where the revenue is coming from and how it's translating into profitability? Number two, will there be a surprise upside in EBITDA? Could it even be positive EBITDA? Right now, consensus EBITDA is basically break even, and the company guidance is a range from negative $2 million to zero. So where is that going to shake out? And number three, and probably the most important metric to watch for on this call, in my opinion, is the second quarter ending member balance as well as the churn rate. Some of the analyst reports I've read indicate churn should be increasing this quarter and into Q3 and could go up to even 8% or higher due to the COVID-driven spike in unemployment here in the United States. In past quarters, analysts usually assume around 3% churn, and the company has historically reported between 2 to 3% churn. So for the startup founders listening out there, keep that metric in mind. How does that churn number benchmark to your numbers? What number are you showing for your long-term assumption in your financial model? You can learn something about what investors expect to see along these lines from what this company is reporting on a regular basis and what its analysts are expecting. All right, let's move on to One Medical. One Medical stock price is $38.38 as of market closing yesterday. This is an increase of almost 74% since January 31st when the stock was trading at $22 at the end of its first day of trading post IPO. Keep in mind the IPO price was $14, so it's up 174% for those lucky people who got in at the IPO price. The company gave a range of revenue expectations back in May, which we've mentioned previously. This range was $56 to $66 million of revenue for the quarter, and they stated that the low end of the range assumes that volumes did not recover at all from the April lows. Those April lows indicated a volume decline of about 45% from pre-COVID volume, and the company's been saying that it's been improving since then. As of today, the Q2 2020 median revenue estimate is $61.1 million, which is right in the middle of the May guidance range. And frankly, it's a lazy number from analysts that mostly haven't updated their numbers since then. So I'm betting the company comes in at or above the high end of the range. What specifically am I looking for on their earnings call? Number one, I want to see what they have to say about utilization in the back half of the quarter and how they expect it to trend in the coming months, especially in California, where the business has about a quarter of its members. It's not just the number I'm looking for. I want to hear their sentiment about how it could evolve in the varying COVID scenarios that are unfolding in front of us. Number two, what are their office opening plans? Are they going to change the plan? Are they still going to open 20 to 25 this year? As stated previously, will those launch dates push back at all? And if so, exactly why? Is it fear of demand, or is it inability to execute because of COVID or some other reason? I think this is the most important thing for me and for the businesses I'm working with in the behavioral space. Not so much from a, will these companies be able to make money perspective, but more so from a, what's the operating dynamic going to be like in the coming months? And number three, how does the company talk about increased unemployment and exactly how that translates into membership, revenue growth, and their outlook on revenue growth going forward? Number four, what exactly is their reimbursement rate for remote visits this quarter? Everyone's talking about how reimbursement rates are at parity between telehealth and in-person visits, which is technically true, but it's totally misleading. In-office visits usually generate ancillary or wraparound services, and a lot of that revenue is missing these days. So how far below the average fee-for-service visit reimbursement rate of about $300 that they were getting before COVID will they be? I really want to find out. And number five, I'm really curious to see what they say about their 19 mobile COVID testing sites, plus their in-office COVID testing. I'm simply just curious about what are they getting paid for these? And finally, let's talk about Teladoc. Teladoc stock price is $218 as of market closing yesterday. This represents an increase of 161% since January 1st when the stock was at $83.72. Today's stock puts the valuation at 20.5x 2020 revenue versus the broader peer group of about 13x on average. Simply put, I can't buck the trend here. I suspect Teladoc hits the ball out of the park with their Q2 numbers, as they've been doing for quite a while. Well, that is the top line numbers, and I'll get into that in just a minute. With the July 1st closing of the InTouch acquisition, there's a lot of excitement around Teladoc right now. I'm eagerly anticipating this call on July 29th, and as with the other companies, I'll share the details in the show notes. Just to recap for those keeping score at home, the company provided guidance on the quarter as follows. They guided revenue in Q2 to $215 to $225 million. They guided EBITDA to between $20 and $24 million. They guided U.S. paid members to between 49 and 50 million, which at the midpoint is up 85% year over year, by the way. They guided visit fee only members to 21 to 22 million, which includes 2 to 3 million temporary members, which we talked about in detail on the Teladoc deep dive that we did a few weeks ago. They also guided total visits to 2.3 to 2.4 million. That's a really key number that I'm looking for on the earnings call. According to the analyst reports I've been able to read so far since the InTouch deal was announced, it seems like most analysts are estimating that InTouch will add about 55 to 60 million of incremental fiscal year 2020 revenue due to the acquisition, but they're still showing EBITDA relatively flat. In fact, one report shows their EBITDA estimate being revised down 2 million after the acquisition. I know everyone's in love with Teladoc right now. All those new users, all that increased demand, those visits are climbing. COVID plays right into their hand, delivering huge year-over-year demand growth. But where is the EBITDA growth? I've been saying this since our deep dive a couple weeks ago. I'm not saying they don't deserve the stock price or the valuation per se, but why doesn't EBITDA grow at all after even an acquisition with all those top-line metrics going through the roof? Does anyone even care? The market doesn't seem to. I mean, there are a lot of companies entering the telehealth space right now, and being first has really never meant winning in many markets. I mean, look at MySpace. Is Teladoc the MySpace of telehealth? A better question is, who's the Facebook of telehealth and how do I get into that cap table? Look, I could be off base here. I probably am. Who knows? But we'll definitely find out in time. Anyway, let's focus on the upcoming earnings. There's 5 things I'm focused on inside of Teladoc's earnings call. Number 1, utilization commentary and trends around daily usage. Number 2, new customer demand. Number 3, I want to hear how they're thinking about adding new services and selling these wraparound services that we've been talking about. Number 4, I can't wait to hear how they talk about In Touch, where we'll get some insight into how it impacts growth, margins, etc. And hopefully we get some long-term synergy guidance as well. Number 5, in a perfect world, I'd love to hear the management talk about how they plan to win in an extremely competitive market where new entrants are coming into the market every single day. Herein likely lies the answer to my EBITDA complaint above. So what does all this mean? I'm an investor in behavioral health startups. I work closely with behavioral health startups, and many of them listen to this show. So what does this mean for you? What does this mean for me? What should we key on during these earnings? I'm not going to get super stoked about any one metric or report here, and I certainly care very little about what these drunken equity market traders think. I'm focused on a few things that can help me think about how to make decisions on the best business models for the long run in the behavioral space. The questions in my mind are things like, should we be going direct to consumer? Should we focus on brick and mortar? Can telehealth only actually get paid the same as in-person treatment? What's the mix of in-person to telehealth going to be 6 months from now, 12 months, 18 months from now? What are actual churn rates like for these member-based models? From those things, I'm going to derive insights into how the public market values these metrics. I'm also going to be refining how I model long-term estimates among startups based on what's going on at these later stage companies and deriving potential return math thoughts. There will be a lot more in between the lines, so to speak, that's relevant to behavioral health startups in this batch of earnings calls than most quarterly earnings seasons, and certainly here in these companies more than most. That's it for this week's mental health market update. To our listeners, thank you for being here. And please, if you like the content, hook us up with a like or a subscribe or a review on your podcast platform of choice. And we'd really love for you to share us with a friend. We also have a Patreon account where our loyal supporters can support our content creation, which will be linked in the show notes. On our Patreon page, we include a detailed write-up of our market update episodes like this one. We also share more in-depth market thoughts, write-ups, analysis, and we share some of the research we're digesting to get smarter on the space that we care about. To the founders out there, don't forget to join the Mental Health Startup Community Slack, which you can find a link to in the show notes as well. And most importantly, we want to hear from you. Please do comment on social media. Let us know what you liked or want to hear more of. You can reach out to us on Twitter at StigmaCast. You can find us on Instagram, Stigma Podcast. You can email us info@stigmapodcast.com. And you can obviously find us on the internet at stigmapodcast.com as well. Thank you for being here. That's it. Until next time, stay safe, be well, and thank you for your support.